You've refined your deck countless times. You've finally received a term sheet that makes sense. The hard part is over. Or is it? This is the moment when many founders breathe a sigh of relief, thinking the money is just days away. But there is a critical phase that stands between you and the funding you've worked so hard to secure. It's called due diligence, and it's where many deals go to die. Due diligence is the investigative process that venture capitalists conduct after issuing a term sheet. It's their opportunity to verify everything you've told them. They will examine your financials, your legal structure, your technology, your intellectual property, your contracts, your team, and virtually every aspect of your business. The best way to understand due diligence is to think of it like buying a house. You see the photos online, you visit the open house, you fall in love with the kitchen and the backyard. You make an offer, but before you hand over the money, you hire an inspector to check the foundation, the roof, the plumbing, and the electrical wiring. The inspector makes sure there are no hidden problems that will cost you later. Due diligence is exactly that. It's the inspection phase of venture capital. And what investors are really doing is confirming the story you've told them. They've already made an emotional decision to invest. Now they need to verify that the evidence matches the narrative. So what does due diligence actually involve? Let's break it down into the four main categories that investors examine. The first category is financial due diligence. Investors will want to see 3 to 5 years of historical financial statements. They will want to see your monthly financial reports, your bank statements, and your tax returns. They will scrutinize your revenue recognition, your expenses, your margins, and your cash flow. But investors aren't just looking at the numbers. They are looking at the story behind the numbers. They want to understand what drives your revenue. They want to see how your unit economics work. They want to confirm that your revenue is real and sustainable. If your revenue is concentrated in a few customers, that's a major red flag. Investors will ask detailed questions about customer churn, customer acquisition costs, and lifetime value. Investors often view their financials through optimistic lenses. They see a world where everything goes right. Investors, however, are trained to look for what could go wrong. They will stress test your assumptions. They will ask what happens if growth slows down. They will ask what happens if a major customer leaves. This is not because they want to punish you. It's because they need to understand the true risk of the investment. The second category is legal due diligence. This is where investors examine your corporate structure, your contracts, your intellectual property, and your regulatory compliance. They will want to see your certificate of incorporation, your bylaws, your board minutes, and your cap table. They will scrutinize your employment agreements, your equity grants, and your option pool. Critical area of legal due diligence is intellectual property. If your company relies on proprietary technology, investors want to know that you actually own it. They will ask for documentation on your patents, trademarks, copyrights, and trade secrets. They will want to see that your employees and contractors have signed proper assignments of intellectual property. If you've used open source software, they will want to know how it's been incorporated into your product. Many founders are surprised by how intensely investors examine intellectual property. But think about it from the investor's perspective. If they invest $5 million into your company, they want to know that you actually own the assets they're investing in. If a disgruntled employee claims ownership of your core technology, that investment could be worth nothing. This is why intellectual property due diligence is often the most time-consuming part of the process. The third category is commercial due diligence. This is where investors examine your market, your customers, your competitors, and your sales strategy. They will want to see your customer contracts, your sales pipeline, and your marketing strategy. They will want to understand your customer concentration and your customer retention rates. Investors will often conduct their own market research during this phase. They will speak with your customers and prospects. They will analyze your competitors. They will evaluate your competitive positioning. They want to confirm that the market opportunity you've described actually exists, and that you have a credible plan to capture. Is operational and technical due diligence. This is where investors examine your technology infrastructure, your product development process, your security practices, and your operational capabilities. For technology companies, this often involves a technical audit. Investors will want to understand your architecture, your code quality, your testing procedures, and your deployment processes. They will also examine your team. They will want to understand how your team works together. They will assess whether you have the right people in the right roles. They will look at your hiring plans and your retention strategies. They will evaluate your culture and your leadership. Now that we understand what investors examine, let's discuss how to prepare for due diligence. The founders who pass due diligence most smoothly are not the ones with perfect businesses. They are the ones who are prepared. With creating a data room. A data room is a secure online repository where you organize all the documents investors will need to review. The more organized and comprehensive your data room, the faster you will move through due diligence. The most successful founders assemble their data room before they start fundraising, not after they receive a term sheet. They know that a well-prepared data room signals professionalism and competence. It shows investors that you are organized and that you have nothing to hide. It also creates momentum in the fundraising process. It should include financial documents, legal documents, commercial documents, and operational documents. Financial documents should include historical financial statements, monthly financial reports, tax returns, and detailed revenue analysis. Legal documents should include incorporation documents, board minutes, employee agreements, and intellectual property filings. Commercial documents should include customer contracts, sales pipeline reports, and competitor analysis. Operational documents should include product roadmaps, technical architecture documentation, and security policies. But a data room is just the start. You also need to be mentally prepared for the questions you will receive. Investors will ask tough questions. They will challenge your assumptions. They will identify weaknesses you may have overlooked. This is a normal and healthy part of the process. The founders who handle due diligence best are the ones who treat it as a collaborative exercise rather than an adversarial one. Let's look at a few real-world examples of due diligence going wrong. Consider the case of a health tech startup that was about to close its Series A. The investors conducted due diligence and discovered that the company had been using customer health data in ways that violated privacy regulations. This discovery not only killed the deal, but also exposed the founders to serious legal liability. The founders had neglected to seek legal counsel about their data practices. The due diligence process uncovered this problem, and the company never recovered. Consider another example of a fintech company that was raising a significant seed round. The investors conducted due diligence and discovered that the founders had not properly assigned intellectual property from a former employee. The employee had left under difficult circumstances and was claiming ownership of the core codebase. The investors walked away, and the founders spent years in litigation. These examples highlight why due diligence matters. It protects both investors and founders. It ensures that everyone has a clear understanding of the business before money changes hands. It prevents future disputes and enables both parties to move forward with confidence. Let's talk about how long due diligence takes. In an ideal world, due diligence takes about 4 to 6 weeks. This time frame gives investors enough time to review documents, conduct interviews, and validate assumptions. However, due diligence can take much longer if there are complications. Complex legal structures, messy cap tables, or significant intellectual property issues can extend the process to 3 months or more. The best founders keep their due diligence process on track by responding quickly to requests. When investors ask for a document, they provide it within 24 hours. When they ask a question, they answer it clearly and fully. This responsiveness builds trust and keeps the process moving forward. It's also important to understand that due diligence doesn't end when the money hits your bank account. Investors will continue to monitor your financials and operations after the investment. They will want to see monthly reports and regular updates. This is part of the relationship between founders and investors. It's not a burden, it's a partnership. There is one final aspect of due diligence that founders should understand, and that's the psychological dimension. Due diligence is stressful, it's invasive, it requires you to reveal every aspect of your business, including the parts that aren't perfect. This can be difficult for founders who are used to presenting only the best version of their company. But here's the truth that successful founders understand. Investors aren't looking for perfection. They've invested in dozens of companies. They've seen every mistake a founder can make. They know that startups are messy. What they're looking for is honesty and transparency. They want to invest in founders who are realistic about their challenges and who have a credible plan to overcome them. This is why the best approach to due diligence is radical transparency. Don't hide problems. Identify them early and explain how you're addressing them. Hear the words due diligence. Don't feel dread. Feel preparation. Feel opportunity. This is your chance to demonstrate that you are the kind of founder investors want to back. That's the truth about due diligence. It's not a hurdle, it's a test. And if you pass it, you build the foundation for a partnership that can last for years. Thank you for watching this documentary on due diligence. If you found this helpful, please hit that subscribe button and give this video a like. It helps more founders discover this content and navigate the fundraising process successfully. We'll see you in the next documentary.